When you think about Australia's massive export economy, you probably picture just these endless trains of iron ore snaking out through the desert.
Right. Or, those giant specialized tankers full of LNG just sitting out on the water.
Exactly. I mean, for years, liquefied natural gas has been the undisputed heavyweight champion, sitting very comfortably in that #2 spot of national resource exports.
Oh, absolutely. It's been a staple.
But if you look at the latest numbers, there has been this massive, almost completely quiet revolution. Gold has just displaced LNG as Australia's second largest resource export.
It's wild. It really is.
Yeah, it rocketed from $47 billion just a short while ago to a projected $74 billion by 2026-2027.
Which is, not a rounding error. That's a huge leap.
No, not at all. That is a fundamental shift in the economic bedrock. But what's truly wild when you look at the mining data and market reports from early 2026 is how this actually happened. It wasn't a smooth ride.
Far from it, yeah.
So today, we're tearing into those balance sheets for you. We want to figure out how these companies are pulling historic wealth out of the ground, why the Australian Securities Exchange, the ASX, has become the ultimate global hub for gold investment, and, how miners are defending these massive margins despite some very real global friction.
Yeah, and it is a phenomenal shift to witness. I mean, we are looking at a 57% increase in the value of Australia's gold exports over just a 2-year period.
The 57%, that's just wow.
Right, and what makes it so compelling is that the mechanics driving this boom, they aren't always intuitive. The broader macroeconomic environment is actually acting as this really complex filter.
A filter? How so?
Well, it's shaking out the weak players and disproportionately rewarding companies that actually know how to operate efficiently.
Which is exactly why we need to unpack the timeline for you, because the start of 2026 was an absolute roller coaster for anyone holding gold.
Well, volatile doesn't even begin to cover it.
Right. I mean, in January, the price went completely parabolic, hitting an all-time record of $5,608 an ounce. But then, almost overnight, the market experienced its steepest one-day fall in over a decade.
Yeah, it plummeted, 21% in a matter of days?
Exactly, 21%. And the catalyst was Kevin Warsh, a guy known historically for a very hawkish stance on interest rates being nominated for Fed chair.
Right, which spooked the markets.
Definitely. And then if that wasn't enough volatility for your portfolio, we saw another unexpected 13% drop hit in March after the U.S. and Israel attacked Iran.
Yeah, that was a huge shock to the system.
But wait, I have to push back on the traditional narrative here. If gold is supposed to be the ultimate safe haven asset, the thing you buy when geopolitics get scary, why did the news of a major conflict in the Middle East cause the price to tank instead of spike?
It feels like a paradox, doesn't it? When you first look at it, it makes no sense.
It really doesn't.
But if we trace the mechanical chain reaction of that conflict, it actually makes perfect economic sense.
Okay, walk me through it.
So when tensions escalated in the Middle East, it triggered an immediate oil-driven inflation shock.
Right.
Energy prices just, bam, shot up instantly.
Right, the oil spike.
Yeah. And central bankers, like Fed Chair Jerome Powell, they look at that sudden burst of energy inflation, and they're forced to react.
Right.
Their primary tool to fight inflation is raising interest rates, or, well, at the very least, holding them high.
Gotcha.
So policymakers were forced into a higher-for-longer stance just to cool down that specific oil shock.
Ah, I see where this is going. Because gold doesn't pay a dividend.
Exactly.
If I can get a guaranteed, say, 4 or 5% return from a government treasury bond, suddenly holding a shiny rock that pays me absolutely nothing just for sitting in a vault, well, it looks a lot less appealing.
That is the exact mechanism. Gold is a non-yielding asset. So when interest rates go up, the opportunity cost of holding gold goes up right alongside them.
So the big money moves out.
Right. Institutional capital flows out of gold and into those yielding assets like bonds, driving the gold price down sharply. That explains the violent short-term speculative shocks you saw in January, March.
So the fear of war caused a spike in oil, which caused a fear of inflation, which cemented high interest rates, which killed the gold rally.
You nailed it. It's a domino effect.
That is a fascinating chain reaction, but reading through the market analyses you shared, it seems like there is a massive structural floor underneath all this short-term chaos, like something preventing the price from completely falling through the basement.
Oh, there is. And that floor is built entirely by central banks.
Really? Central banks?
Yeah. For the third consecutive year, central banks are buying over 1,000 tons of gold annually.
1,000 tons? That's an unfathomable amount of metal.
It is. We are witnessing a major de-dollarization trend, particularly from emerging markets. Institutions in China, India, Poland, Turkey, they are aggressively diversifying their national reserves away from the U.S. dollar.
So they're physically buying the gold.
Yes, stockpiling physical metal. This is not speculative day trading. This is structural, long-term, price-agnostic demand.
Meaning they don't care what the daily price is, they just want the gold.
Exactly. It creates a baseline vacuum that absorbs a massive amount of the shock when the speculative hedge funds decide to sell off.
Which brings us to the core of our deep dive here. If central banks are pulling 1,000 tons of physical metal off the market every single year, that creates a massive supply vacuum. You can't just, print gold.
Right, you actually have to dig it up.
You have to find a politically stable, resource-rich environment capable of scaling up heavy industry to meet that demand, which explains why capital is flooding into the ASX right now.
Absolutely. The Australian Securities Exchange is the place to be.
Because the sheer scale of Australia's output is hard to wrap your head around. They are expected to hit 369 tons of production by 2026-27, arguably making it the largest producer of newly mined gold on the planet.
Yet the scale of the Australian operations right now is, well, it's operating at a level we haven't seen in decades. You have multiple massive jurisdictions firing on all cylinders across the continent.
Using, what, entirely new generations of extraction tech?
Yes, exactly.
If you're looking at a map of these mega projects, Western Australia is the undisputed heavyweight. You've got mega projects over there like Northern Star's Hemi deposit, which is expected to treat 10 million tons of ore a year by 2030.
10 million tons. Just let that sink in.
It's massive. But it's not just the West Coast. Over in New South Wales, you have Regis Resources pushing the McPhillamys project. Down in Victoria, historical fields are being reworked. And up in the Northern Territory, there's Vista Gold's Met Todd operation.
They're everywhere.
Yeah. When I was reading through the source material, the way I started conceptualizing this high-price environment is, well, it's like a geological time machine.
A time machine. Okay, walk me through that.
Well, think about it from a purely mathematical standpoint. At $1,800 an ounce, certain low-grade dirt is just dirt.
Right, it's basically worthless rock.
Exactly. It costs way too much in diesel and chemical processing to extract the tiny microscopic flecks of gold out of it, so the mine shuts down. But when the price is sitting at $4,000 or $5,000 an ounce, suddenly that exact same old, previously unprofitable dirt becomes a highly lucrative ore body again.
Yes.
You are essentially traveling back in time and reviving these old historic gold fields because the math suddenly allows it.
That is a really highly accurate way to look at mining economics.
Right.
It all comes down to what we call the cutoff grade.
The cutoff grade.
Yeah. For anyone analyzing these companies, the cutoff grade is the absolute minimum amount of gold you need per ton of rock to break even on the processing costs.
Okay, that makes sense.
So when the gold price doubles, your cutoff grade drops significantly.
Yeah.
And because that math suddenly works on lower grade material, we are seeing a historic reallocation of capital across the Australian market.
So the high prices are dragging the money in.
High prices are acting like a super magnet. Right now, a staggering 40% of Australia's entire mineral exploration budget is being poured directly into gold.
40%? That is a massive slice of the pie. That money has to be coming from somewhere. Are they pulling it away from the green metal sectors?
There are, yeah. Capital is highly unsentimental. Explorers are pulling funding away from greenfield exploration for lithium, nickel, and copper, for the so-called battery metals, and pivoting aggressively to proven gold regions.
Because the returns are just faster.
Exactly. The immediate free cash flow returns are just too good to ignore. Now, this raises some very serious questions about the long-term supply chain for the energy transition, but for the gold sector, it is sparking a modern renaissance.
So where is all this money going specifically?
We'll take the Paterson province in Western Australia, for example. It's a region operating under deep geological cover, meaning the gold isn't sitting on the surface.
It's buried.
Deeply buried, under hundreds of meters of barren rock. With this massive influx of capital, companies are finally able to deploy advanced deep drilling technologies to unlock entirely new emerging powerhouses in that specific region.
So we know where the dirt is, and we know there's a flood of money being spent to drill into it. The next question for you, if you're looking at these markets, is who is actually pulling it out efficiently?
Right, because finding a deposit is only half the battle.
Exactly. The real trick is grinding it up and separating the gold without going bankrupt in the process.
Top-line revenue means absolutely nothing if your operational costs consume all of your margins.
And you definitely have the absolute giants dominating the headlines, companies like Northern Star, Evolution Mining, and Newmont, which is a massive global player with a heavy footprint on the
The
ASX.
majors.
Yeah, the majors. But the really exciting space, the area where investors are seeing some incredible leverage and growth, is the mid-tier
Oh,
sector.
the mid-tiers are fascinating right now.
The reports highlight one company specifically taking advantage of this environment, Greatland Resources. They've really emerged on the scene, making a very prominent showing in the All Ordinaries Gold Index, particularly with their operations at the Telfer mine over in that Patterson province we just talked about.
Grayland is an excellent case study. Analyzing their operations forces us to look at the most critical metric in the entire gold mining industry,
AISC.
AISC.
Yes, that stands for All-in Sustaining Cost.
So if I'm looking at Greatland's balance sheet and I see this AISC metric, I assume that's not just the diesel in the haul trucks. That's got to be a fully loaded number, right? Like everything from the explosives used in the pit down to the corporate office coffee.
It is the ultimate comprehensive accounting metric. Historically, mining companies used to just report their cash costs, which was literally just the fuel, the labor, and the explosives.
Let me guess, it made them look way more profitable than they were. Incredibly profitable. But it hid the reality of the business. So the industry adopted AISC. It includes those direct cash costs, but it adds in the sustaining capital required to keep the mine running.
Oh, like replacing broken equipment?
Exactly.
Yeah.
If a massive $5 million haul truck blows an engine, replacing it goes into the AISC. It includes the continuous underground development drilling, the corporate overhead, and crucially, the money set aside for environmental reclamation when the mine eventually closes.
So it's everything.
It represents the true, unvarnished cost of producing a single ounce of gold.
The ultimate scorecard for efficiency. And looking at the broader industry data, the Australian average AISC right now sits at roughly 2,335 Aussie dollars per ounce.
Right.
But Greatland Resources, their Telfer operation is running at a highly competitive 1,736 Aussie dollars an ounce.
That's a huge advantage.
And I also see Ramelius Resources flexing even harder at their met magnet operations, boasting an insanely low AISC of just 1,310 Aussie dollars an ounce. Those margins are incredibly wide when gold is running so high.
They are. And a major factor driving those low costs at places like Telfer or Met Magnet is the resource grade.
The grade of the ore itself.
Yeah. When you have a higher grade of gold per ton of rock, you are moving less waste material, crushing less rock, and burning less fuel to get the exact same ounce of end product.
That makes total sense.
But there is another layer to this profitability that is unique to the ASX, and it involves the exchange rate multiplier.
This is where the currency conversion comes in, right? Because global gold prices are quoted in US dollars on the news, but these ASX miners pay their workers and report their earnings in Australian dollars.
Exactly the dynamic to watch. When the Australian dollar softens, say, dropping to around 0.69 against the US dollar, the domestic price of gold absolutely explodes.
Because of the conversion math?
Right, think about the math. Even if the US dollar gold price stays completely flat, a weaker Aussie dollar means local miners are suddenly getting paid significantly more in their local currency. Over the last year, we've seen domestic gold prices push aggressively past 7,000 Australian dollars an ounce.
Wow. Getting paid 7,000 Aussie dollars an ounce, while your all-in sustaining cost is sitting at 1,736 like Greatland, that is a money printer.
It generates a level of free cash flow that fundamentally transforms a company. We aren't talking about creative accounting or paper profits here.
Real cash in the bank.
Yes. These mid-tier companies are generating so much physical cash that they are wiping out their debt facilities entirely. They are sitting on pristine, debt-free balance sheets.
Which means they can reward investors.
Exactly. This allows them to offer incredibly stable, robust dividends to their shareholders. And even more importantly for their long-term outlook, they can fully fund their own high-growth expansion projects and capital expenditures without having to borrow a single cent from the banks at today's punishingly high interest rates.
Okay, let me push back on this perfect rosy picture for a second. You cannot run a massive industrial operation moving millions of tons of rock in the middle of the desert without massive real-world friction.
Fair point.
I mean, inflation is embedded in everything. Energy grids are strained. We read constantly about the severe labor shortage across Australia. Doesn't it cost an absolute fortune to run these massive crushers and fleets of machinery right now? How are their margins not collapsing under the weight of these operational headwinds?
The operational headwinds are severe. And it's a very valid challenge to the bull thesis. The shortage of technical professionals is particularly acute right now.
Like engineers and geologists.
Yeah, we are talking about a critical lack of senior geologists, project directors, specialized metallurgists. It's a highly competitive market, and companies are having to completely redesign their fly-in, fly-out, or FIFO rosters.
Just to get people to the sites.
Exactly, offering better lifestyle balances and massive salary bumps just to attract and retain talent.
So with labor costs spiking and diesel prices fluctuating, how are the costs not spiraling completely out of control?
Here is the reality check that many casual observers misunderstand about mining mechanics. When people visualize mining costs, they immediately think of giant diesel trucks burning thousands of liters of fuel and power-hungry processing mills grinding rock 24/7.
I know I did.
Right. They assume energy is the dominant cost. But mathematically, fuel and power actually only make up about 15 to 20% of a mine's typical AISC.
Wait, only 15 to 20%? I would have guessed closer to half.
Most people do. But labor is the true heavyweight on the balance sheet, consistently accounting for 35 to 50% of total costs.
Wow.
So while energy price spikes certainly hurt, they don't derail an operation the way a labor crisis or a drop in ore grade would. However, this brings us to one of the most counterintuitive aspects of gold mining finance in a bull market. It's a phenomenon we can call the royalty trap.
The royalty trap. I like the sound of that. Break down the mechanics of it.
Well, if you look closely at the quarterly reports, you might have noticed that the average AISC has been creeping up across the entire industry over the last year, even for the best operators.
Yeah, the data showed it inflating quite a bit, which made me think inflation was finally catching up to them.
A significant portion of that reported inflation is actually a mathematical illusion. A mine's AISC is highly inelastic right now because of state royalties.
State royalties, like taxes.
Similar, almost all mining agreements require the company to pay a percentage of their gross revenue, known as an ad valorem royalty, directly to the state government or the underlying traditional landowners.
Ooh, I see the trap. Because it's a percentage of the gross revenue, as the gold price skyrockets, the actual dollar amount of the royalty payment skyrockets right alongside it.
Precisely the mechanism. The royalty payment is a direct, mandated component of the AISC formula. Let's say the gold price jumps from 3,000 to 7,000 Aussie dollars. The royalty payment more than doubles.
And that gets baked into the cost.
Yes. Suddenly, the miners reported AISC mathematically inflates on their quarterly report. The physical mine itself could be operating more efficiently than ever, burning less diesel, utilizing automated trucks, hitting higher grades, but their official cost per ounce still goes up.
Because they're making too much money.
Exactly. It acts as a sort of...
The source material highlighted this heavily. We are seeing some absolute mega mergers happening right now. Case in point, the massive 12.6 billion Aussie dollar merger between Genesis Minerals and Vault Minerals. That dominated the headlines. But mechanically, why is buying another company better than just expanding your own mine?
Because building a brand new processing mill from scratch in today's environment is an absolute logistical nightmare.
Just the red tape alone, I'd imagine?
Exactly. You are looking at half a decade just to navigate the environmental permitting for water usage and tailings dams. The capital expenditures required to order specialized crushers and ball mills involve massive international supply chain lead times.
And finding the labor to build it.
And finding the specialized construction labor to build it in a remote area is incredibly difficult and expensive. So companies aren't building, they are merging.
Which perfectly explains the Genesis and Vault Minerals play. By merging, they bypass all of that friction.
It is the ultimate execution of the hub-and-spoke model. By merging, they create a massive, dominant regional footprint.
So they share resources.
Right. Instead of Genesis spending billions of dollars and waiting 5 years to build a new mill for their freshly dug ore, they simply merge with Vault. Now they can load their high-grade ore onto haul trucks and drive it 50 kilometers down the road to Vault's existing, fully permitted, and underutilized processing infrastructure.
Oh, wow. It's all about creating localized, highly efficient processing hubs.
Exactly. It's synergy in its absolute purest form.
You bypass the government red tape, you avoid the construction inflation, you solve your CapEx problem, and you immediately start pouring gold and printing cash. It makes perfect mechanical sense why we're seeing this wave of consolidation sweep across the ASX mid-tiers. You either become a hub or you become a spoke.
It's a race for operational efficiency. The companies that can successfully execute this hub-and-spoke strategy continuously feeding high-grade ore into established, paid-off mills. Those are the ones that will generate the most durable, long-term value for their shareholders, regardless of short-term price fluctuations.
Incredible. We've covered a massive amount of ground today. We started by looking at how geopolitical shocks, like a hawkish Fed chair nomination or conflicts in the Middle East, can trigger chain reactions in oil, inflation, and interest rates that violently swing global gold prices.
It really highlights how interconnected the global economy is.
Yeah, and we explored the supply vacuum created by central banks and how the Australian dollar acts like a massive supercharger, multiplying profits for domestic miners and pushing the ASX into the global spotlight. We got down into the dirt with mid-tiers like Greatland Resources and Ramelius, unpacking the granular reality of AISC, resource grades, and that fascinating royalty trap.
The royalty trap is definitely my favorite concept here.
It's brilliant. And finally, we looked at how billion-dollar processing hubs and mega mergers are the mechanical solution to the physical headwinds of labor and inflation.
It is a profoundly complex financial and industrial ecosystem, but when you break down the mechanics of the mining life cycle, the underlying logic driving this boom is incredibly clear.
But as we wrap up, I want to leave you with a lingering question, something to mull over as you watch your portfolio or read the market news this week. We've spent this entire time talking about the gold being pulled out of the ground today. But if you look at the long-term data, global average discovery rates, the actual finding of new, massive, world-class gold deposits have declined by 40% since 2010.
Yes, that's a staggering figure.
Industry analysts are staring down a very real looming cliff called peak gold, predicting that global production will permanently plateau or even begin to decline by 2026 to 2028.
Which presents the ultimate supply-side dilemma. Once this current wave of M&A runs out of mid-tier targets to acquire, and once these aging mega pits finally tap out their reserves and hit the bottom of the ore body, where will the world actually find its next generation of gold?
That is the multi-billion-dollar question. It brings us right back to our geological time machine. Eventually, even the old dirt runs out. Thank you for joining us on this deep dive. Keep exploring the markets, stay curious, and always look beyond the headline numbers. Catch you next time.